N. Sivaraman, President and Whole-Time Director, L&T Finance Holdings, joins us. Sivaraman, you worn the infra hat when you were in L&T in the finance department, and now, of course, you are a lender for infra and other companies. So your comment on the infra bond rules announced by RBI, will it suit both banks and infra companies?
So let's look at it in multiple dimensions. I think on the overall, I will say that it is positive, okay, for the sector as a whole is what I would believe is. If I look at it from the borrower perspective, right, because a large part of lending does come into the sector from the banks, on the banks being funded by deposits, the lending community has not been able to take a long-term pricing view on lending into the infrastructure sector. So typically you end up either doing a fully free-floating way of lending or lending with a reset at some periodic intervals. For a leveraged business, which is infra is, because you end up operating at about 3 times to 4 times the leverage on equity. So clearly any volatility or fluctuations in the interest cost has an impact on the equity returns. Today, with the combination of 5/25 structure as well as with the lending backed up by long-term bonds, either by banks or by the NBFCs, it just created a far higher level of stability in the price to the infrastructure projects. So I would consider it, assuming that the promoters do look at it as a positive, because if someone is looking at it as a declining interest rate environment, he will end up borrowing on a floating rate basis. Whereas that's not a very good thing in an infrastructure segment, because your inflows are more or less based on a fixed rate. So that's going to be positive for the sector. Second is that if I look at it from a capital market development point of view, banks are perhaps the best institution to really raise larger quantum of borrowing, enabling more investors to participate. And also that banks are generally seen to be a better credit. So there will be larger participation of both retail and institutional investors into the segment. So all in all, we might see far more evolved capital market. A lot more of investors participating, so there could be good amount of liquidity in the various instruments that the banks might issue. So I would consider this also will be a positive, even for a player like us. A well-developed market will be positive. Okay, that's what I'm seeing.
But all this depends on whether banks will find adequate buyers for their 7-year bonds. Will depositors transit to the 7-year bonds? Will there be other buyers for these bonds?
Let me speak from our own experience of raising long-term money. I think even in the current market, while the supply is a little limited, but we are able to get borrowing at a price which is less than bank's lending rate for us, and I think marginally higher than the deposit cost of the banks. Okay, that's what it is. Of course, the distribution cost of such long-term borrowing is going to be something additional. Okay, that's what is one will have to consider. But all in all, I don't see this to be substantially higher than the 5-year fixed deposits as it stands today, because the participants are going to be both retail as well as institutional money that will come into the segment. So if I look at it from a lender perspective, just continuing to respond to your previous question. I think it also gives them far more stability on the liability side to support the asset build-up. Even I think it in fact for even NBFC like us, it brings us as well as the banks on a level playing ground, because ultimately the source of money will end up being the same set of investors. So it subject to only the credit rating based differential or credit view based differential, we'll be able to attract money from the same set of say investors.
Okay. Well, coming to another issue then, the removal of tax SOPs for debt mutual funds under 3 years has led to a big selling of corporate bonds. Are you seeing redemption as well? I mean, are you getting hit?
No, I think this could be a temporary adjustment issue. Ultimately, all the service providers, be it the banks or the mutual funds, will have to work towards building a longer-term capital market based products. So that's what would develop. Those mutual funds who have got a good credit perspective and be able to manage the investment side well will definitely stand to gain. In addition to that, with a good liquid market, I think the investors will find a way of routing their investments through the mutual fund to be more profitable. Otherwise, each one will have to start building a fairly large credit function. So it's going to be a period of adjustment, but I don't see this to be overall having an impact. There will be, yes, it does impact in the shorter term the development of capital markets. I hope the government allows that adjustment period by appropriate legislative changes.
All right, coming to the economy then, the macro balance is improving. I mean, IIP is rising, inflation is falling. Are you seeing any impact at all on asset quality?
Yes, I think while the big changes in terms of actual improvement in NPA situation will take some time, the existing levels of NPA. As you said, the new NPA accretion will slow down in the next quarter or so is what our outlook is that. We are also seeing the reduced pipeline of restructuring. So this should sound good for us in the say near term, say about 2 quarters from now. We should see improvements coming through really. That's what our outlook is. But big change on the terms of growth, new projects, the cash flow improvement at our constituents, I think it's still will have to be calibrated in our assessment on that.
Oh, okay. So even NPL start picking up only after 2 quarters. You were looking out for a relationship with Yes Bank. What's the latest on that?
I said I think our responses are not going to be very different from what we have given in the past. It's so we don't respond to speculative statements, madam.
Then let me put it this way: how does L&T Finance see itself in terms of banking ambitions now?
From a strategic perspective, we continue to remain interested in becoming a bank. That will be a good and natural evolution that we can we would aspire for, because it will enable a fairly good growth without increasing the level of risk. Right? We can accelerate the growth without increasing the risk on the balance sheet and P&L. Having said that, I think we are not discouraged that we are not got a bank as a part of our portfolio. We'll continue to invest in diversifying the liability side and making sure that our growth aspirations in the medium term remains attractive for us. That we'll continue to be focused on. As and when the guidelines do come out, we'll evaluate and then take the right steps, what form it should exist, and whether the wholesale consumer bank or universal bank, which should be the one that we should aspire to be. That's a call we'll take when the regulatory clarity emerges.
All right, we'll leave it at that, Sivaraman. Thank you very much for joining us. I think one key takeaway is that the infra bonds will pick up, but on the NPL front, we have to wait for good news.